Welcome to John and Jeff Do Less podcast, where we discuss economics, policy, politics, talking about people that are doing too much and why why they should be doing less. So,
Yes.
Jeff, thanks for being with me
Yeah, no problem. Thanks for having me
on our shared podcast.
on. Yes.
um, so today, we are going to be discussing the Federal Reserve. What is
And
it? What is it supposed to be doing? What is it doing? What's the theory? Um, why do we need it? What else do you think we'll cover today?
and we're going to talk about why they're doing way too much.
Yeah,
I
Ac-
think the
of course.
Federal Reserve is king of doing too much.
hmm Yeah, that's a good point. It's kind of what got us. Well, I'll speak for myself. It kind of
Mhm.
is what got me really intrigued. Really sparked my passion for understanding, you know, global economic uh, trends and news. It's really just what does the Federal Reserve do? How much power does it have? Why does it do what it does? Do we need it? All these questions really, it really incited a curiosity in me, mostly because most of the answers I found, and that make sense to me, are not are not the answers that are colloquially discussed by the general population.
hmm
I don't know if you feel similar, if you have a different kind of take on
Yeah, I
what
mean,
made you interested.
basically, like, what got me interested in economics was, like, uh, when I started making a little bit of money and I had some money to spare, people would tell me, oh, you got to invest it, you got to invest it. And I was like, I don't know what that means. So, I did some research. Like, I didn't even, like, when I had graduated uh, college, I still only had a periphery understanding of what a stock was and what the stock market was. Um, and I was like, all right, so, like, how does this thing work? Like, what? I think the main thing was, like, okay, I was looking at all the different stocks I could buy and, like, the prices, and I'm like thinking, okay, why is this a good price? What does this have anything to do with this? And the more I started to understand it and, like, look into things, I happened upon some articles talking about how the Federal Reserve was going to change policy in, like, 2018, and that was going to have an impact on the stock market. And that to me seemed like they had a lot of power, and yet not that
Yeah,
many people
right.
were talking about them at the time, because the stock market is, like, this super important thing that represents many, many different people's retirements accounts, like 401ks. Lots of people's savings are tied up with the stock market. And so it's something that's super important. And then here's this thing, the Federal Reserve, which has a huge influence on the return of the stock market. And yet it was something I understood very little about at the time.
Right. Yeah. So yeah, something with such large ramifications, such large implications as the stock market, being able to be controlled, not controlled, but affected largely by policy of the Federal Reserve. It seems that that kind of flies in the face of what our Constitution stands for. That no single entity would go unchecked in a way that would allow them to maintain such large influence on something as important as the stock market, which kind of today goes as a large reflection of how our economy is doing. So it's almost like begs the question, like, why does
hmm
that entity have that much power? Like, who gave them that power?
Yeah. Well, I mean, we can talk about um, how it started. And so basically in 1907, there was a financial crisis, not as big as the Great Depression, but probably if you read about it, it's pretty similar to what we had in 2008, that type of thing. Um, Essentially, what happened is you had a 50% fall in the stock market and a lot of panic. You had a bit of a run on the banks, a lot of people going bankrupt. Sounds pretty familiar to if you were around during 2008 financial crisis.
And what you're
Um,
describing is called the Panic of 1907.
yeah,
Just
that
for
was called the
clarity.
Panic of 1907. And in response to that, people were enticed with the idea of having a central bank to essentially prevent like a liquidity crisis where there's a run on the banks and people can't get their money out. And so they people wanted the Federal Reserve, which would be able to supply banks with extra money if they needed it, if there's a run on the bank, and essentially they would take that money back when the panic subsided. That's kind of like the idea. And um, so they passed that act in like 1913 to essentially have a central bank to control the money supply so that in times of panic, um, you could prevent um, a liquidity crisis where people can't get their money back, type of thing.
Yeah, so the logistics of that, to be clear, is the Federal Reserve, which was created as the central bank, started to issue notes called Federal Reserve notes, which if you look, I don't know if, well, actually, did they start issuing in 1913 Federal Reserve notes, or was that, or they just standardized them in 1913?
Um, Not sure.
Yeah, well, regardless, if you look in your wallet today, the important thing is you have Federal Reserve notes. I hope you have Federal Reserve notes in there if you are able to
I just
feed
have
yourself.
condoms.
um, yeah, those Federal Reserve notes in your wallet or in your online bank account are um, obviously issued by the Federal Reserve, the Fed, as we call it, and they're dollars. That's what the dollar is. It's a note issued by the Federal Reserve, redeemable for redeemable for
Well, at the
nothing.
time, at the time, gold.
At the time, gold in
Yeah.
1913. So, which is actually a great deal. Instead of
Mm,
carrying around wheelbarrows full of gold to go buy a new Porsche, which at the time was just an actual horse,
all right.
you would you'd be able to just carry these little notes around,
Right.
and you don't have to, save a bunch of money on wheelbarrow costs.
Right. And so essentially, what the Federal Reserve did was it had a just pile of gold that it sat on, and this was like you can think of this like a water tower, right? So if everyone turns their shower on at the same time, uh, then you need like an excess of pressure to get that water pushed through. So that's like what a water tower does. And so what the Federal Reserve was, it was just a hub of all this gold because every dollar was backed by gold. And so it was just like a hub where they could push out gold if there was like a run on the banks.
Right. Um, and the gold standard, what that means is that every dollar, uh, like physically, if I took a dollar back to the Federal Reserve and I handed them a dollar bill, they would hand me the equivalent of gold at that time. So it was like the money in your pocket was representative of something. And the reason I kind of made a point to earlier in this, in this line of thinking about what are they redeemable for today, and that's actually not the case anymore. You can't take your dollar bill and get any amount of gold for that. If you take it to the Federal Reserve will say, sorry, that dollar is yours. We can't give you anything for it.
Yeah. Well, so I don't remember. I think we'd have to look up what it used to trade for. I think it was like $1 was, or it was like $30 was an ounce of gold or something.
Yeah.
Let's see what it
I think
was.
a dollar, I think a dollar, like the word dollar used to mean an amount of gold. So it was like,
Right.
but yeah, so, and that inflection happened in 1971 with the Bretton Woods system coming to an end, where basically the Federal Reserve up to that point had maintained, you know, an exchange rate of dollars for gold. After that 1971 inflection point, it was just the Federal Reserve said sorry. If you before this date, if you would have brought us dollars, we would have given you gold, and after this date, if you brought us dollars, we will not give you gold. So they basically just said
Right.
it's now a fiat currency, which is what a fiat currency is.
Yeah. Um, in the Great Depression, they changed the exchange rate of gold. So they essentially, if you think of the dollar as like um, a security in a sense, right? Like it's a note and it's an IOU for gold, right? Just in the way that like if you bought a bond, that's an IOU for dollars. So if they didn't give you your dollars, that's the same as defaulting on the bond. Well, multiple times in the US history, like your dollar, which is an IOU for gold, would not get you the amount of gold you were promised. That happened multiple times in history. So people often think that the US has never defaulted, but that's not really true because they've defaulted multiple times on essentially what is the dollar.
Mm. And then in 1971, it was just one big default where they said no longer, if you thought you were
Right.
getting any gold for those, it's no longer the case.
Right.
Um, which they actually, it wasn't out of nowhere. It wasn't like they just decided that and everyone had to deal with it,
Mm-hmm.
because the dollar did actually have a inherent value in that it was the reserve currency of the world. So nations all over the world were using dollars as a reserve for trading to denominate imports and exports in order for different nations with different languages to be able to communicate and convey, proper exchange rates and value, you know, getting the correct value for goods and services across country country borders.
Mm-hmm.
The dollar was extremely instrumental in that it held the world reserve currency status. So converting $2 was the easiest thing to do when you were trading with a currency that wasn't your local currency, which meant that there was actually a huge demand for dollars inherent in the world at the time. So relinquishing the gold standard wasn't just like a carpet being ripped out from underneath the U.S. population's feet. The dollar was
Mm-hmm.
already so useful in the world and it already had value that the Federal Reserve felt justified in no longer meeting the obligations of gold backing each dollar.
The original gold standard was about 16 to 1. So $16 per ounce. And then in somewhere along the way, it went up to $20 an ounce. And then in 1934, during the Great Depression, that was when FDR revalued the dollar to 35. And the reason they're doing this, right, is so the government was spending money and accumulating debt, right? And in order to pay off its debt, it needed dollars. But the dollars are backed in gold. So if it didn't have the actual physical gold to pay off its debt, there's a problem there, right? Because it needs actual gold to pay off its debts, because it's a hard ratio, right? But if you revalue that dollar to represent less gold. So if you're going from gold is $20 an ounce to 35, that's essentially a, you know, almost 50% reduction in the value of those dollars. So you can basically default on half your debt if you do that. So in the Great Depression, what was happening is they're spending a bunch of money on these like jobs programs and stuff to like try to get people working because there was like not a lot of work to go around, and they're just trying to get out of this funk, and in the process racked up so much debt that they couldn't pay off because they didn't have the gold to. So they had to change the ratio so that they could essentially default on their debt.
Right. Yeah, so you mentioned the Great Depression, so we might want to, so if we're discussing the history of the Federal Reserve, we might want to discuss causes of the Great Depression, which, as far as I'm concerned, yeah, well, actually, as far as Milton Friedman is concerned, if you ask Milton Friedman, who people widely, or not widely regard, maybe some, if you ask some people who's the greatest economist who ever lived, they would say Milton Friedman. And according to Milton Friedman, the Great Depression was a failure to act by the Federal Reserve. There was another, similar run on the banks. People lost faith that their money that they deposited in banks would be there in the future, and so they wanted to run to, essentially literally run to the bank and pull out whatever money they could, which the Federal Reserve, as Jeff has already mentioned, is a liquidity provider in instances such as that. So what the Federal Reserve could have done was to provide liquidity in that case, in the case of a bank run, and allow people to get their money out. And I believe the Fed chairman at the time is quoted as saying, so they did not provide liquidity, and I believe the chairman was quoted as saying, we were waiting for a real matter to deal with, a real serious matter to deal with, rather than what we were seeing, with what we now call as the Great Depression. So I'm loosely quoting what the Federal Reserve's stance was at that time, but obviously that failure to act, we all know what the effect was.
Right.
The Great Depression, which is largely regarded as the worst financial crisis in the history of the world, really.
Right. And so I think the legacy of that continues to shape our policy today. Like, you can still see the scars of what happened in the Federal Reserve's policy today. For example, the Federal Reserve has this policy today where they try to have like a 2% inflation rate every year. And, a lot of people just accept that for what it is. Okay, 2% inflation a year. But if you think about what that means you're losing 2% of your savings if you just put them in the bank or whatever. Like, if you just have dollars under your mattress, the dollars you earn today lose 2% of their value every year, because the money supply gets inflated. And so your standard of living is essentially constantly going down due to this policy. And so you might ask, why are we doing that? And basically the reasoning is they're afraid that deflation is going to cause a spiral into a Great Depression. And so to me, though, that's a bit of a correlation and not a causation, right? So we had huge amounts of deflation during the Great Depression. And that was because you had this liquidity trap, right? Or liquidity crisis, sorry. where there was a huge run on the banks. People couldn't get their money out, so the lending basically came to a halt. And so, whenever the money supply is basically built on not only the amount of money that's around, but the amount of loans, right? Because that also is a form of money. And so, if all the lending just stops because people are panicking, then that's a huge decrease in the money supply. And so, that's very deflationary. But the key there is the the end of the credit lending, or the shrinking of credit or lending, is what causes that deflation, right? It's not the other way around. It's not that, prices are going down or the money supply shrinks and then that causes lending to cease. It's not the other way around. And so, to me, this idea that we need constant inflation to prevent deflation is kind of nonsense.
Yeah, so yeah, just to kind of reiterate a couple of the things that you touched on, that was a good logical progression. But you mentioned the 2% target came about because in 1977 there was an amendment to the Federal Reserve Act. The Federal Reserve Act of 1913 was the creation of the Federal Reserve, and then
Mm-hmm.
1977 the Federal Reserve Act was amended, um, directing the Board of Governors of the Federal Reserve System and the Federal Open Market Committee (FOMC), which is just a meeting that the Federal Reserve Governors, or Board of Governors and Chair, hold to discuss policy. Um, the amendment was directed them to maintain, I'm quoting, maintain long-run growth of monetary and credit aggregates commensurate with the economy's long-run potential to increase production, so as to promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates. So that's what has come to be known as the dual mandate of the Federal Reserve. So that there've been this source of liquidity in times of emergency, but that was the first time that they really defined the vehicles to achieve this destination that they're trying to reach, which
Right.
is promote the goals of maximum employment, so reduce unemployment, and stable prices, so reduce any kind of volatile inflation or deflation. So that
Right.
was the inception of the um, you know kind of them employing their their goal for reducing unemployment and reducing inflation.
Yeah, I think this
Specific.
is a key turning point in the Federal Reserve, right? And so, like, the original Federal Reserve, uh, they don't, they're not really doing much, right? In fact, they saw the Great Depression as not enough of a crisis for them to do anything, right? So the original Federal Reserve, really, they didn't do much at all. They
Right.
really took do less to heart. And so I think the 1977 change is really a key turning point in essentially what the Federal Reserve is. Okay, because now they have this mandate, which starts to sound like central planning, and that's exactly what it is central planning. Is they're trying to achieve these optimum outcomes. And that's where it starts to get kind of messed up for me, because to me it seems pretty absurd that just some team of people can figure out the optimum money supply, interest rate, yada yada yada, to make sure that the economy is just as healthy as possible, right? Like what would make these people so hyper intelligent that they could figure out the proper interest rates and everything to set such that our economy is as healthy as possible. Like that's when it starts to get a little fishy, I think.
Exactly. Yeah. Right. Yeah. They're trying to seek this goal of a healthy economy, and I don't think anyone that's kind of that knows about what an economy is. There's so many moving parts. There's so many
Hmm.
variables. There's so many people. There's so many products. There's so many changes every day from day to day. There are shortages here, and there's overcapacity in certain sectors, right? There's so many unlimited variables. There's unlimited knowledge to know about an economy at any given point. But starting in 1977, they have two variables: unemployment and inflation. So those two variables, that's the measurement at which they're now they're now dictating what a success is. If they're deviating from success, they're deviating from low unemployment and from low inflation, then they're failing. So they must do in their inventory of options to enact policy something to correct those two variables to maintain quote unquote a healthy economy.
Right. And so, and to me, the craziness here is so. If anyone knows some history about the USSR, Stalin has these things he called his 5-year plans, right? And essentially, what these were they were 5-year economic plans, right? And so he would basically just pick certain economic goals he wished his economy to achieve, right? And so for the first 5-year plan, I don't know the exact measurements, but he essentially, if there wasn't enough farming, he would say, okay, we need to increase this sector by this much and this one by that much. And so he's essentially planning out all like these few sets of variables that he wanted to achieve. But the problem would be is that, you know, he couldn't know exactly how much like corn was needed and how much of this was needed and how much is that. And so there's no way to accurately predict exactly how much of each thing you need. And so you're always going to get it wrong. And he always did get it wrong. And here we are in a supposedly free economy. And there's these two rather important variables like inflation and unemployment. And we're just setting goals on them and trying to manipulate our way to hit those goals. And that's going to have repercussions because, you know, maybe the economy doesn't need this amount of inflation. Maybe it needs something else. You don't like, there's no way to know what's needed and what's important. And so we're just setting these goals, but not understanding any of the side effects that they have.
Right. The other thing I wanted to mention that you touched on was how the you briefly mentioned the 2% target for inflation
Mm-hmm.
and how that's not a it's not a mathematical it's not a product of some mathematical long form proof, long form economic theory.
Mm-hmm.
What that is basically is it's just someone deciding, deflation was terrible. We had deflation. We had some massive deflation in the Great Depression. That was terrible. We should never see deflation again. We really should do what we can to avoid deflation,
Mm-hmm.
right? But we also don't
Right.
want to see massive inflation because obviously that's bad too. What Jeff was mentioning about, standard of living, or purchasing power eroding from inflation. So we kind of just want it in the middle, but we want to err on the side of not deflation. So we're going to set it, that's about 2%. And they kind of, put their finger on 2% and said that is what inflation should be from here on out. 2% per year is, 2% inflation of the US dollar is what we will see in a perfectly healthy economy. Which, that just goes to show, that sounds like Stalin. That sounds like Stalin saying we need 2% more, 2% inflation forever.
Right.
That's the solution. That's in my all-knowing, in my infinite wisdom, 2% inflation. When really there's a bunch of different things. There's a bunch of different things that could play in, and there are scenarios where deflation is actually not a bad thing. In fact, as consumers, as a consumer, you might think deflation is actually a good thing. Like if I want to buy a TV, and the TV costs $2,000, and I waited a year, and now it costs $1,000. I wait another year, and it costs $700. That's cool. Now I couldn't afford one TV 2 years ago, and now I can afford two TVs because simply the economy got so efficient, and the competitive marketplace for TVs was so efficient and competitive that TVs themselves, to me as a consumer, without doing anything, became cheaper to me. That's price deflation. That TV, for the same amount of dollars, I could buy more TVs. That's actually a strengthening dollar. The Federal Reserve says, no, that's bad. That's the worst thing that could happen in the economy. That sounds like the Great Depression. Well, for me, that sounds like I get more TVs. You know what I mean? So there's so many subtleties that go into a marketplace with inflationary and deflationary forces.
Yeah, and like you're constantly seeing different sectors having either increasing prices or decreasing prices, right? So like when I was working in the lighting industry, we had a really hard time as a business with deflation, right? Like it was so competitive in the LED market that the technology was getting better and better and better, and everything was just cost down, cost down, cost down. And the price of the LEDs was just getting cheaper and cheaper and cheaper. But like for all the people in, contracting business, this was potential for new avenues of business. You started seeing these new businesses pop up where they'd, go to a big skyscraper and say, hey, we'll replace every light in your building with a more energy efficient LED, and you'll save a ton of money on your electric bill, and we'll just take a piece of that for doing the replacement for you. And so for us, it was squeezing our profit margin, but for other people, it was generating new businesses, right? And so like for one producer, deflation might be a problem, but for another, it's a win. And generally for the consumer all around, it's a win. And so you're always seeing deflation here, and sometimes you see inflation, right? Like, so if in the oil market, if the inventories are piling up and there's like less oil on the market, then the price of oil goes up, right? So that's inflation of the price of oil. So you're constantly seeing like deflation and inflation all the time in different things. And so it's not like those markets that are seeing deflation are just collapsing, right? So it doesn't seem to be a problem in individual markets, but somehow for the total overall market, we just have to have inflation, which doesn't make any sense to me.
Right. Yeah, the argument I often hear about why deflation is so bad is, then the economy will crawl to a halt because, as people say, who would buy a house when you can buy a house next year for, if there's 5% deflation next year, the house is going to be 5% cheaper. And my answer to that is somebody who needs to live in a house. You know what I mean?
Right.
Like, there's such a thing as informed transactions where somebody is paying a price today that they're content with. They're happy with the price. If perceived value in living in a house, and I'm willing to pay, $400,000 today to live in this house for the rest of my life,
Right.
then I will move forward in that transaction. It doesn't matter what the price of the house to me. It doesn't matter what the price of that house is later on in the future, because all I care about right now is, putting myself in this house today, because I would like to live in a house and I need
Right.
somewhere to live.
And if you never ever planned on selling that house for the rest of your life, its price is essentially irrelevant to you once you've purchased it. Like
Right,
if you have a fixed mortgage and you're like, yep, it's affordable now and I want to live in it and I like it and I want it, you're going to buy it and you're going to say, who gives a fuck what the price is for the rest of the time because I'm never going to sell it.
right.
And
The
so,
only time
what,
I care about inflation or deflation or like change in price in a house I want to buy is if I'm
mhm,
speculating. If
right,
I'm speculating on I want to be able to resell this in the future, that's when I care. And that's actually a bad thing for an economy when there's rampant speculation, because rampant speculation causes bubbles.
right,
And bubbles can pop, and that can cause some bad things to happen in an economy.
right.
So,
That's sort of what happened in 2008 is people were just all speculating housing price would just keep going up and up and up and up. And then when it didn't, that's when everyone who was using loans they couldn't pay back to buy houses, all those loans went bankrupt, and so the lenders got screwed, the lendees got screwed, their house got foreclosed. It was bad for everyone all around. And but the problem is part of this behavior was enabled by the Federal Reserve setting interest rates probably lower than they should have been. Again, like me or John doesn't necessarily know what interest rates should be in like a market determined interest rate, but most likely it was too low considering the behavior we saw. And this is the reason they were setting interest rates low was because after the 2000 dot-com bubble burst, they were worried about a recession. So they dropped interest rates super low for a while. And it's like,
well, yeah, it was in a recession. They were in a recession. They wanted to get out of
yeah,
the
but it
recession.
but it was a mild one, right? Like the dot com
Right.
bubble and the recession following it were pretty mild in the grand scheme of things, and yet interest rates were dropped down very low and held low for a long time. And a lot of people now recognize that this is what caused the bubble in the housing market.
Yes, and just to clarify, since we're doing like the whole history of like how the Fed started an act in the FOMC, their Federal Open Market Committee, um, right? So their aim is to reduce unemployment and reduce inflation, and they have two vehicles to do that. One we've already talked about as the provider of liquidity. Um, I mean, they issue dollars, so they are the only entity in the entire world that can print dollars. And
Hmm.
in doing so, what did that look like originally? And that's what Jeff was talking about with the exchange rate going from 20 to 1 to 35 to 1. They were essentially creating dollars where there were none before. They were essentially printing money. Then came the times when they actually printed money with a printing press. On the printing press, they were able to, print what we have in our pockets right now, dollar bills. And then now in the present, um, and in the future, they can, when they print money, it doesn't necessarily have to be on the printing press. They can do um, something such as buy a government treasury and create the money out of thin air, create the bits that they would need to wire. I have money in my bank account online. That money doesn't exist anywhere except for bits on a computer. So the Federal Reserve, what they can do is just create the bits out of thin air.
Right.
So those are the two vehicles that the Federal Reserve has at their disposal. The or sorry, I didn't say the second one. The first one is the liquidity, is providing liquidity, and the second one is they are able to set the rate at which banks lend to each other overnight on their cash that they have on hand. And that what this is called is the Fed funds rate. and it's a huge that rate that the banks lend to each other overnight, it's actually very largely dependent, or it's there's a lot of other rates that are largely dependent on that rate. So by influencing that rate, they are able to enact their force, the force that they want to enact on the economy. They're able to do so through that dictate. If they dictate that the Fed funds rate should be, 1.75% to 2%, then then banks have to lend to each other overnight at that rate, which affects the loans that the banks give to other banks, for other durations. Depends on, or it affects the rates that they offer to consumers for different durations, and it basically affects all of the lending in the entire economy. So when they
Right.
raise the rate, the lending in the economy is at raised interest rates, and when they lower the rate, the lending in the economy is at lowered interest rates. And Jeff did
Right.
touch on that when he was talking about after the 2000 dot-com bubble burst, they artificially lowered they lowered rates to an artificially low level at which it made borrowing easier in the economy. It allowed entities seeking loans, they were able to get loans at a lower price.
Mhm.
At a higher. They were able to get
Well, like
loans
if
at a
you
lower
call
interest rate.
interest, yeah, like if the interest is basically the price of a loan, so the lower the interest rate, the lower the price of a loan. So essentially, like if you think about it, just like anything else, if you lower the price of something, you're gonna get more demand for that thing. So you're gonna get more lending. But
Right.
yeah, like if you think about it in a, if the market's completely free, it's not manipulated. There's no central body. Then there's going to be some market determined price of interest, just like there would be for the price of corn or whatever else. Like
Right. It's a market.
there's
There's
right, there's a
supply and
market
demand
forces
for
that
it.
there's supply and demand setting the price of something. So the price of interest would normally be set by market demand for loans, right? So if there's not a lot of and supply of them, right? So if there's a low amount of savings and really high demand for loans, like a lot of people have some really good ideas or whatever, they really need that money, but savings are low, you should expect a high rate of interest. And that's kind of actually the environment we're working in today. Is we have a low amount of savings, um, and yet and probably, I don't know, I wouldn't say necessarily a high demand for lending. Probably we do to sustain a lot of the companies that are losing money. That's probably generating a lot of demand for loans. Like an example you might have seen in the news recently is WeWork. It's a perfect example of a company that basically only exists because interest rates are low. They just were not able to even get close to making a profit. They were losing billions of dollars every quarter. And the only way you can do that is you can get loans at a cheap enough rate that you just keep getting more and more debt. And then as long as you can get enough revenue to pay off your debt, you can just keep that thing going. And so companies like that are probably pushing on demand for loans, and there's not a lot of savings. So we should expect a high interest rate, but the Federal Reserve is doing everything it can to keep that interest rate low. And so instead of these companies like WeWork, I mean, it is going bankrupt now, but like a company like this had no business getting as big as it did. And so when you have these low interest rates, you have these really big companies who employ lots and lots of people, which may seem like a good thing, right? But if all those people are basically helping build this company that is not viable, it can't make money on its own, it's never going to profit, essentially all those people are wasting their time. And so that company should not exist. And these people should find employment in something else that is profitable, is productive, and is a good use of their time. And so you may be able to keep GDP measures and stuff afloat and make the economy seem healthy by lowering interest rates, by letting companies get cheap loans and keep their little thing going, and all those people don't have to get laid off. And it seems like a good thing, and we have avoided recession for some time. But the reality is we're keeping people employed in things that are not as productive as we could be. We're not generating as much value and as much wealth as we otherwise could be. And so this slowly can eat away at the wealth we should be generating over time.
Right. Yeah, so to kind of provide a little bit of context for that, there's this quote I really wanted to share um, from Alan Greenspan, who was the Federal Reserve Chairman um, in the 80s. The market was facing a lot of volatility. There was a lot of risk. The corporate institutions were really lacking confidence in what their financial futures would be. It was a time of heavy uncertainty, and Alan Greenspan came out. Actually, before I even say that, the the chairman of the Federal Reserve before him was faced with similar uncertainty, and he raised the Fed funds rate up to 20%. He was facing inflation, so they raised the Fed funds rate really high, and the inflation went away, but they did go into recession. So it was kind of like a bit of medicine that he served the economy. Like, this isn't going to taste good. You know, the economy's going into recession. A lot of people were out of work. You know, it was a really hard time for a lot of people. But in squashing the inflation, he actually served the American people in the longer run, to, you know, kind of provide an actual, he provided a sustainability almost, where the short-term recession actually led to a longer-term, you know, safety of the U.S. dollar. But then, so I'll follow that up with Alan Greenspan, who became Fed chairman in 1987. Later in the year that he became Federal chairman, or Federal Reserve Board chairman, he came out and said, "The Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today its readiness to serve as a source of liquidity to support the economic and financial system." And the reason that this was really a crucial turning point for the Federal Reserve was this was a signal to the markets that, faced with uncertainty, the Federal Reserve was not only acting in its dual mandate. The subtext of that quote is that, you know, especially the part where he says we're looking at the financial system. He was kind of verifying that not only are they looking for long-term, not only are they looking at to lower unemployment rates long-term and lower inflation long-term, but to keep the financial system chugging along, to keep the markets happy, which was never in their mandate. But the fact that he indicated that that's something they'd be focusing on set a precedent for Wall Street, set a precedent for Federal Reserve Chairman from then on, and we can really see it today in how the market acts and how the Federal Reserve Chair reacts. Even though those two variables that they look at, unemployment and inflation, have nothing to do with the stock market, that was kind of the indication that no, the politically, quote unquote, politically independent Federal Reserve was not so politically independent. They weren't as independent as they should be, in that they have a conflict of interest almost, where they are actually going to be looking at financial markets and easing for the sake of, or trying to ease the quantitative. I'm sorry. They're trying to. This basically led to quantitative easing in order to keep the market afloat.
Right.
Which is my point is that is not what they're meant to be doing. That's not why they exist. They're not supposed to be sending the stock market up. But quantitative easing, which we can talk about,
Hmm.
was specifically, if you look back to Alan Greenspan's motives, was specifically something that was trying to keep the stock market, afloat and continuing to go up.
Well, quantitative easing was Bernanke.
Right, but what I'm saying is this was a precursor to,
Oh, okay. Yeah, I see what you're saying. Like he set
like
the
he's,
precedent.
yeah, he set, yeah, because it was Greenspan, Bernanke, Yellen, and now Powell, and all
Yeah.
four of them are the ones that tended towards, making the markets happy, as opposed to just something like Volcker did, which was kind of short-term pain in the markets
Hmm.
for long-term, stability. Whereas today we're seeing do whatever it takes to make the markets happy, as opposed to just low unemployment and low inflation.
Right. And I mean, I don't think they're simply just like it's as simple as like, oh, I just want the stock market to go up just cuz or whatever, like cuz it'll make people like it's I think there's an immense amount of political pressure not from like Trump or anything like that, but like from what is essentially everyone's pension, retirement account, 401k, IRA, all these things are filled with stocks and bonds and other things that essentially they desperately need the like this kind of bubble to keep chugging along, right? If they, you know, raised interest rates higher, to try to get them back to normal so that they're not, you know, I mean, the danger in what we're doing right now is getting runaway inflation. And people say it's nothing to worry about because inflation right now is, it's like 2% around there. And so they're like, oh, we're fine, we're fine. But, you know, that's just looking at the change in average prices, essentially, right? And so you could imagine a world in which actually our technological innovation was so good that we actually should have been getting a ton of deflation, right? And so this, you can think about the amount of like money printing and all this other stuff and low interest rates that they're doing as overcorrecting so much that it's dragging up what should have been large deflation all the way up to like what is actually inflationary. And so, um, you know, it may look like there's low inflation, but really there's like a lot of deterioration of the average person's savings in order to benefit things like stocks and bonds and everything else. And so I think this is why we're seeing a lot of this populism starting to happen is the average person doesn't really own that many assets. They may not own like some of them own a house, but maybe let's look at someone who's towards the bottom end of the ladder. They don't own stocks, they don't own a house, they don't own bonds. They might have like a low interest savings account. And now, if the Federal Reserve is doing things like quantitative easing, which is just a fancy word for printing money to buy things like stocks and bonds. Well, they've never bought stocks, but they've bought bonds. And lower interest rates a lot, which when you lower interest rates, that sends the stock market higher and it sends housing markets higher. And so people who own all these things benefit, right? And that's rich people. And people who don't own these things, their savings are basically being inflated in order to increase the value of all these things that rich people own. And so I think now more than ever, you're seeing a lot of frustration from the average person because they're noticing their life just isn't getting better at the same rate that people at the top are. And so this is, real consequences. I think this is part of why Trump is so popular right now. It's part of why socialists are especially popular on the left side. And it's because they feel left behind by the system. And I think this is a large part of this, almost the majority part of this, is because of what the Federal Reserve is doing. And so essentially what they're doing is they're trying to appease all the people that vote, people with like retirement accounts. Those people go out and vote at the sake of like all these other people who tend not to vote as much. But they're not even elected, so it doesn't really matter. But it's just like, I don't know. It seems like they're just prioritizing one, because I don't think people realize what's happening right now. Like, they would notice if everyone's 401k got cut in half, right? Like, people would be up in arms if that happened. But if people's like checking account is the value of that's being slowly eroded, it's kind of like the frog boiling in the pot. Like, you just don't really notice. So I think people at the bottom, they don't realize what's happening to them right now. And it's at the sake of preventing that haircut people would take on like their retirement account, which they definitely would notice. I don't know if that makes sense.
Right. No, yeah, talking about, so we're getting into the effects of the Federal Reserve, kind
Mm-hmm.
of when we started, I kind of mentioned, what are they doing? What should they be doing? So
Mm-hmm.
the discussion about, their mandate, what they should be doing, what they
Mm-hmm.
should be doing, since they control such an important part of our economy, which is lending. That's how,
Mm-hmm.
that's really the vehicle in which an economy can grow efficiently is if there's efficient lending. So to mess around with the lending market, you're really messing around with not only today, but the future of the economy.
Mm-hmm.
Um, and so if they get it wrong, it has tremendous consequences. And so what should they be doing? They should be hearing signs of what you mentioned before, how there's not much savings. There's not much savings, and there's a lot of borrowing, and there's a lot of speculation. All
Mm-hmm.
those are signs of a bubble, and what they're doing to combat any kind of slowdown that might be resulting from uh, anything in the market that could cause a slowdown, or like a cease of hiring people to lose their jobs. They're
Mm-hmm.
lowering interest rates further so that it's easier for corporations to stay around and easier for them to borrow money. And artificially low interest rates, just as you said, raises the price of assets. So people that own assets, well, who owns assets? Rich people. And who
Mm-hmm.
doesn't own assets? People that are towards the poorer end. So
Mm-hmm.
what they're actually doing with their short-term goal of keeping the economy chugging along and escaping any kind of recession at all costs is they're actually increasing wealth inequality, for
Right.
one. So what should they be doing? They should be seeing that, and they should be afraid of that. They should be afraid of extreme inequality. Jay Powell, who's the current Fed chair, has mentioned inequality as a problem that he sees,
Mm-hmm.
which doesn't make sense because if he's lowering interest rates, he's not addressing that problem. He's doing the opposite of
Right.
addressing that problem and making it
And it's
worse.
like, I don't think he realizes he's doing it though. Or maybe he
I mean,
does,
the
and maybe
question,
he's just a liar. I don't know.
right? It's hard for me to understand how he can say recently he said in like an address after the FOMC meeting where they set the rates.
Mm-hmm.
He comes out and says straight up, I don't see any problems in the economy right now. When debt is at an all-time high in many different sectors, transportation is at like an 11-month low, or transportation for freight freight, like
Right,
measures of freight
like
activity,
shipping.
shipping activity, yeah, all
Hmm.
freight, shipping,
Yeah,
trains,
and like
trucks.
manufacturing's already in a recession.
Right. So for me and you to be able to recognize that, and for him to say, "I see absolutely nothing of
Like
concern,"
like he's
it's like
obviously lying.
it's obviously lying.
Right. Of course he knows these things. If he doesn't, like that would be absurd, right?
Right. And
But
I think
that's
I think we really should talk about. So I mentioned quantitative easing, and
mhm.
to combat so what quantitative easing is bulk purchases of securities in the open market by the Federal Reserve. Now, if you've been following, you may be thinking the Federal Reserve can print money. So what business does it have purchasing securities in the open market? Because if you're
Mhm.
purchasing securities in an open market, the market for securities, contains all sorts of investors, and
Right.
all investors have something in common. They have a fixed budget, or they have a fixed amount of money that they can invest.
Right.
Federal Reserve does not have a fixed. They can print
Right.
money. They print money to rise to the
Yeah.
occasion of whatever they want to buy. And
And
yeah, you go ahead.
if they're buying securities, guess who likes that? The people who own securities, right? Because then that means they get it at a higher price for basically free, right? Because the Fed's just creating that money to buy it.
Right, exactly. And who are they buying it from? Well, they're buying what the securities that they bought were largely uh, federal treasuries and mortgage-backed securities that were held by the banks who were on the brink of collapse. Um, the large banks in 2008 were at the brink of collapse for what Jeff had said about the calamity caused by mortgage, the mortgage bubble that existed,
Hmm.
where people thought that the that leveraging yourself on the bet that housing prices were going to continue to go up was a safe one. So banks became over leveraged to that exposure, and when that ceased to be true, when housing prices started to go down, these banks had no liquidity, and they were going to, you know, file for bankruptcy, which would have been devastating for our economy.
Hmm.
It would have been a lot worse than what we saw in 2008. But what the Federal Reserve did to step in and save the day, supposedly, quote unquote, save the
Hmm.
day, was purchase these securities from the banks, called in a quantitative easing action, with the intention of purchasing. So the Federal Reserve balance sheet, which is their assets and liabilities on their balance sheet, was $800,000. I'm sorry, $800 billion before quantitative easing, which is a lot of money, but it was kind of like organic growth from that. It was kind of just like a straight line up to eight
Right.
hundred
It took
thousand
like
over the past, yeah, like 40 years.
$100 years.
Yeah, 100 years to go 800 billion. Well, they purchased their balance sheet expanded to 4.5 trillion dollars of assets that they had in total. So that's a growth of 3.7 trillion dollars over the course of about 3 or 4 years through
Hmm.
several rounds of quantitative easing. So just massive money printing to purchase these securities. They said
Yeah.
it wasn't money printing. They said it was just a temporary. Yeah, they just said it was just temporary, a temporary action. They were just buying these securities with the intention
Right.
of selling them in the future, selling them back to the banks.
And you'd think with all that money printing we'd see inflation, but basically what happened is banks took those like cash injections and then just stored them at the Federal Reserve because the Federal Reserve pays them to hold excess reserves because that's another way one of their incentives to keep banks, from like
Solvent.
they implemented to keep them solvent. Excess cash that prevents like a run on the banks, keeps them from going bankrupt, and so there's a little incentive to hold their reserves at the Federal Reserve. So banks are basically getting paid to hold on to these reserves. So they're just making money for no reason. So like if it feels like the banks aren't playing fair, it's because they aren't.
Right. So the the quantitative easing that was done in the early 2010s um, supposedly saved the day, right? The stock market
Right.
went down 20, 30%, but then
Hmm.
ever since there, that bottom, it has gone up, it has gone up um, a lot. I don't have the number, but ever since like the bottom where the Federal Reserve announced quantitative easing would be starting,
Hmm.
the stock market has just gone up and up and up.
Right. Until they
So,
started to reduce their balance sheet in
right.
like 2018 and raise interest rates, the stock market started to tank, and they changed their mind in like they did that for like 3 months, and then they were like, nope, we're done with that now. So what was supposed to be temporary, they got about 3 months in. It was 10 years. They're like, took them to even attempt to undo what was supposed to be temporary. So 10 years they waited to finally undo this thing they said was going to be temporary. And 3 months in, they gave up. And now it's right back to where we were.
Yeah, that's the key. That's the most important thing. That's the most important thing we're looking at today with the Federal Reserve. How in 2008 we were faced with a crisis. We were faced with the Great Recession, and the Federal Reserve came in to save the day. They performed quantitative easing, and they dropped interest rates all the way to zero. So interest rates were low, and uh, the the central bank was, quantitative easing was providing excess liquidity into the economy. The rationale behind that, and I'll be honest, it could have worked in an ideal world. To provide
Hmm.
excess liquidity and to provide low interest rates would allow businesses to grow, new businesses to form.
Hmm.
If it really shored up our economy, if it allowed businesses to grow unimpeded over a 10-year
Hmm.
period, then hey, yes, it worked. It worked as you planned. But the measure of it working, the measure of how much did we shore up the economy was okay. Now start to take away that that liquidity that you injected in the early 2010s and start to raise interest rates to a normal level. Because zero
Hmm.
is below the normal level. So once you start to do that, you start to do um, just not even raising interest rates. Well, actually, the interest rates went up to about 2%. So the high before the Great Recession was probably around 5%.
Yeah, it was
So
like around there.
they got back up to 2.5. They got up, like half
Halfway.
to what it was before. And the market started to crash. Businesses said we can't handle this. We have too many we took on too many loans. Well, the
Hmm.
Federal Reserve wanted them to build their business, to start to save and to start to invest in their future. But what they did instead was they took out loans for short-term, expenditure, and they
Right,
never
because why wouldn't you? Because it was so cheap.
exactly. The Federal Reserve provided them a 0% interest rate and told them, don't take on debt, start to invest in your company's future. Well, the company said,
Right.
well, why would I do that? You know, I can borrow at 0%. I can borrow free money. Why would I invest in the future of my company when if I want to really see my quarterly stock earnings, when I publish my
Right.
quarterly stock earnings, I really want to see that number as maximized as possible, like maximized to the full extent I possibly can. And
Right. Because you
so
can
not
jack up your share price real quick with some extra money, like with a ton of leverage and super low payments. So if the interest rate's like almost zero, right? Then your monthly payment on that interest is like nothing, right? But with all that extra capital at hand, you can make a lot more money. You can get a lot more growth. So your cash flow, your earnings is going to explode. It's going to make your business look very good in the short run. And so like that could drive up your share prices a ton, and then you can just cash out and get fucking rich.
Yeah, and also a lot of executives at corporations are incentivized. Their incentive structure is based on this the stock price, the share price.
Right.
So if you can take excess if you can take in excess cash flow for exactly
Mm.
what you're saying, Jeff, and also for share buybacks, you can literally, as a company, just buy back shares, which will also send the stock price up. So it
Right.
created all sorts of moral hazards. Just the Federal Reserve, in an attempt to give the economy another chance to live to fight another day, it actually made the problem 10 times worse. It just did the exact opposite of what it should do. It tried to
Right.
prescribe a solution to a problem that was caused by the solution that is was being prescribed by the Federal Reserve.
Right. So
And
we're
so,
sort of like trapped in this cycle at this point, and there's really no way out at this point. Like, it's just gonna keep. We're gonna have to keep driving interest rates lower and lower, and we're already at zero. So now they're talking things like negative interest rates, or just the Federal Reserve right now is printing money, and they're barely even mentioning it. They're like, oh, it's nothing. It's not quantitative easing. It's just whatever. It's just short term interest rates. It's nothing.
yeah, they're
And
afraid to
over the
call it quantitative easing. They're afraid to call what they called quantitative easing the first time. They're afraid to call it that
Word.
again because to admit that this is what they're doing again, when the first time they did it was supposedly temporary, if they're
Hmm.
doing it again, that proves that the first time they did it, it was not temporary. It's a
Right.
permanent increase of the balance sheet, which
Exactly.
is just debt monetization.
Right. And so essentially we're in this trap where we basically have to just keep printing more and more money in order to prevent like this deleveraging from happening. When I say deleveraging, that means like people from defaulting on debts, you know, restructuring, downsizing, having layoffs. This is all the stuff that happens in a recession in order to shore up these loans to make sure, you know, in order to pay back these loans that you couldn't pay back and all that good stuff that happens when you try and fix the problem. But instead, we just have to perpetually keep the supply of money uh, getting bigger and bigger so that people can keep maintaining what we're in. And so we're essentially trapped. And the only way out is for them to let interest rates normalize. But at this point, we're so deep in this trap that it would be so immensely painful that they just can't bring themselves to do it because of how politically unpopular it is. But the reality is, I think what they're doing is they're driving a huge wedge into wealth inequality, and people do not, they really don't see this. When you have people like on the Democratic side talking about wealth inequality, you have it on the Trump side too. Like Trump, a lot of people voted for Trump because he's going to bring their jobs back or whatever. There's like a lot of promises to like the majority, right? Like populism, like I'm gonna make the economy work for you. So everyone out there can sense it, but I don't see anyone who notices and is pointing out that a lot of this is due to what the Federal Reserve is doing.
Yeah, no one is talking about the the moral hazards created by the Federal Reserve when and when I try to think about why that's the case, I think when it comes to politicians, they're incentivized not to talk about it because to talk about a truly uh, redistribution of wealth to a redistributive policy of the Federal Reserve, maybe raising interest rates, maybe not quantitative easing. Well,
Hmm.
that's really bad for the federal government because quantitative easing um, lowers the price of the government's borrowing since quantitative easing involves buying U.S. government treasuries being what the government issues to borrow to spend at a
Right.
deficit.
Right.
When politicians, if a politician was in favor of less quantitative easing, that means making it more expensive to borrow, And also, I mean, obviously, raising interest rates would make it more expensive to borrow because you have to pay higher interest. So those two things for to a politician means that they can spend less. And when a politician can spend less, they can't do necessarily they don't have as much power and they can't do what they want. So
Right.
politicians are actually are also negatively incentivized. So every entity in this situation is incentivized against acting, uh, incentivized against calling out the Fed and addressing the real stem of the problem of this economic inequality. Either that, or they don't understand it. A lot of people just
Right.
take the Fed as like you know an all-knowing. They're all economic PhDs. They all have PhDs. So a lot of people say
Right.
that the Federal Reserve, they've got their quantitative analysis and their formulas and all this really complicated stuff. It's not complicated. It's obvious. We've seen
Right.
bubble after bubble inflated by the Fed and crash down, and we're seeing the same thing again. And but people just aren't calling it out. So it's
Yeah.
really
But
up
they got
for
their PhD, their
yeah.
pretty huge dick, so they can just predict exactly what is going to happen in the economy. They're all knowing. There are saviors, like they're going to take care of us.
Right. It's
Uh,
it's absurd. And it's up to us as you know as the educated populace, well, as the populace to
right.
become educated, to understand what the Federal Reserve is doing and call them out and say, we don't want this. We don't want corporations to exist that shouldn't exist. We don't want value
Right.
destroying corporations which are destroying our standard of living and 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 strengthening the gap of inequality. We want
Right.
a true economy that's growing and allowing market forces to win the day and to allow value creating entities to come forth and and win more market share, and that's the way forward. Not just trusting the PhDs at the central bank to to maneuver our way out.
Right. And like if you ask yourself, "Oh, like a recession, like that's so horrible. That's terrible." Like how could you want that? How could you want layoffs and things like that? Well, like to me this is an opportunity for the average person, right? A recession. Like yes, some of us are going to get laid off and we're going to lose our job and that's going to suck. Um but if you have money saved up and you handle your money properly, this is also potentially a buying opportunity. All those stocks that are overpriced now suddenly are not overpriced. Now you can get your money in at a reasonable value and you can start to build your portfolio. Maybe housing will get cut down to a place where you can now finally afford to buy a house. Like this is for all the people who have nothing, a big financial crash is a buying opportunity. And when all these businesses go bankrupt and all these people get laid off, well, those people are just as talented as they were before they got laid off. And now all their labor is freed up to do something new and better. And so new businesses will come along and use their talents in a better way that isn't doesn't need to be enabled with debt. You know, the businesses that couldn't get started because labor is so expensive because unemployment is so low, maybe these businesses will be able to get off the ground and we'll start to see better growth. So it's not all negative. Like, yes, it is negative. And for some people, it could be extremely painful and others. But right now, what's happening is we're basically letting the Federal Reserve pick the winners and losers. And the winners are a smaller number of people than the number of losers right now.
Yeah. Um, they should just be honest, I
Yeah,
think. They should just be
right. Yeah, I mean, I would say if you're listening to this, go out, read some stuff about the Federal Reserve, and don't just take our word for it, but like read into it yourself. Like we're just a couple of assholes, but we've done a lot of research, and I think what's happening with the Federal Reserve is, it's honestly one of the biggest problems facing America right now, and yet not very many people are talking about it, other than Trump saying, drive interest rates even lower, and so he's just advocating more of the same. That's policy that got us here in the first place. So, I mean, maybe we should talk solutions a little bit, I guess, right? Because here we are for an hour talking about the problem. I don't think we mentioned
Right.
anything about like what should be done, right?
Right. I mean, it's tough. I've had this conversation with people, and
Hmm.
a lot of times, yeah, that is the next question. What's the solution? And it's tough because it's like the solution was to not do make this mistake in the 80s, not make this mistake in the not in 2000s and the 2010s. Um,
Hmm.
there's really no soft landing. A lot of people kind of
Hmm.
dream about, like people in our
No.
situation that are seeing this. They say, "Oh, there can be a soft landing if the Federal Reserve
Hmm.
just enacts good policy." But there's
Hmm.
really no soft landing. Like a lot of a lot of the investment there is out there is malinvestment, and
Hmm.
malinvestment is investment into a value destroying entity. It's
Hmm.
not profitable. It requires further investment to maintain itself, which is just a money pit. It's just a money sink. You're just losing
Right.
money in that. So the answer is to get rid of that malinvestment. And
Hmm.
a way to do that is to either raise rates to a normalized level, or just allow the market to set rates. Banks are perfectly
Right.
capable of determining how much they want to lend to each other based on
Right.
risk and credit assessment. Banks are very very um, they're very very high tech addict. They're what's the word I'm looking for? Competent,
Competent.
yeah, competent institutions that are able to rank each other based on credit risk. They're not competent in not being able to see what's speculative and like a bubble when it's forming. They're just fueled by greed and um, short-sightedness and
I mean,
short-term profits.
we're all fueled by greed.
Right, right. I mean, it's not a bank's
Yeah,
responsibility
there's
to.
nothing wrong with
Right,
being greedy, in my opinion.
right.
It's just that's what people are. We
Right,
gotta acknowledge. We gotta realize that.
right. So,
And it's not a problem until they're getting special help from the like a government
right,
body, like the Federal Reserve.
right.
Like
Greed
if
when
the
it's
banks were being
unchecked,
greedy,
unchecked.
right? If they're being greedy on their own devices, I don't see that as a problem. But if they're getting favors from the Federal Reserve and et cetera, that's when it
Right.
begins to be a problem.
If you're greedy and you want to turn $100 into $1,000, but you know that there's 10 times more likelihood that you're going to go to zero, and you still act, then it's like, okay, well, I mean, you wanted something to happen, and you understood the risks,
Right.
and you went for it. And so whatever happened, either you make money, congratulations, or you lost your money. You know,
Hmm.
that's unlucky. But greediness in that scenario, it's met with the educated sides of what can happen. But
Right.
if that person wants to turn $100 into $1,000, and they're told, you know, that it's 100%, it's a surefire thing that it's going to happen. $100 will turn into $1,000. Just do this, and everybody listens to that. Well, you got to look
Hmm.
at why are they thinking that? Like that doesn't make sense.
Right. Hmm.
Whatever information prevailed to make them think that needs to be stopped, because that's not like that's a fairy tale. That's imaginary. There's no
Right.
such thing as risk-free reward. It's risk and reward
Right.
are the trade-off. So um,
Exactly.
so greed that's unchecked, that's not founded in reality, is a bad thing. And I think the Federal
Right.
Reserve has a lot of blame to be assigned to going back to Greenspan, to make the markets think that pile on the risk, because the Federal Reserve has got your back when it comes to we're not going to let the stock market go down. So
Right.
it's just done everybody a disservice in that. Except I guess the people
Right.
that get massive paychecks on Wall Street. But
Well, yeah, I mean, like they're making winners and losers. That's what they're doing. Not
right,
everyone hates the Federal Reserve. A lot of people are rich because of it,
right,
and so like they're just picking winners and losers. But the reality is the winners are people who don't need the help.
right,
You know, they're probably pretty smart people already. They're probably pretty industrious. They could probably get rich, or mildly wealthy on their own. They just don't need the help.
right.
You know, and so we should not be just like sacrificing our economy to help these people out. Like, it just doesn't really make sense.
Right. Yeah. And so back to what I was saying, like allowing rates to go back to a normalized level, well,
Hmm.
it's going to be bad for a lot of people because that malinvestment is in the form of large corporations, and large corporations employ a lot of people in our country. So
Right.
what it'll look like, what the solution looks like, is a lot of short-term pain, a lot of companies going out of business, a lot of unemployment,
Hmm.
probably a lot of inflation, which is
Hmm.
bad for everybody holding dollars.
Well,
Everybody who
I don't think
transact,
I don't think there will be inflation if the Federal Reserve doesn't do anything
right?
or raises interest rates or whatever. Like, if they let interest rates rise, I think there would actually be deflation.
Yeah, that's actually true. That's a good point because
Um,
the inflationary scenario is if rather than all these defaults that are going to become very prevalent, allowing them
mhm,
to actually default, if the Federal Reserve steps in and provides excess liquidity beyond, what we've already
mhm,
seen, which is already extremely unprecedented,
mhm.
they're going to be providing. The first time was 4.5 trillion. The next time might be 8 trillion, 10 trillion.
Right,
So
right.
um, that in that scenario, that would be deeply, deeply inflationary. The dollar could plummet in value, and so everyone holding dollars. But that's not the solution. That would be the part of the problem.
Right. That's more of the same,
Right.
to the extreme even. Um, so yeah, I mean, I would say what the Federal Reserve needs to do is they need to do less. They need
Yeah.
to take some advice from this podcast.
Take
But
hands.
the
Yeah.
the reality is, if you look at uh, so we talked about how the Federal Reserve was printing a bunch of money right now as we speak, to keep overnight loan rates at the Federal Reserve, right? So they spiked up above it, on the market. Like, there's types of loans that compete with the Fed funds rate, and those loans spiked up to like 8 and 10%, where they should be at like 2% because there's just not enough save or reserves on the market, and so the Fed stepped in to provide more reserves to keep those rates low. So the reality is, if the Fed just stopped doing anything, we could be seeing short-term rates spiking up to like 10% right now.
Hmm.
In fact, they did already before the Fed did something.
What he's
So
referring
like,
to is the repo rate, overnight repo
right, yeah, it's like
repurchasing.
overnight repurchase. It's
Yeah,
basically just like overnight lending. It's similar to what
short term
the
lending.
federal
Yeah,
funds is. Yeah, it's very short-term lending. But again, all lending like competes with one another, right? So it's like, if that short-term lending spikes up, other lendings are going to be affected by it as well. So like, I think if the Fed just stopped doing anything, it could be pretty severe. So I think what the Fed basically needs to do is take a look at everything they're actively doing and just start to roll back until they're basically at the point where they're not doing anything.
right. Which is such a hard thing for them to do because there's such like a cognitive bias to like if you see something happening in your purview
Hmm.
in your like realm of in your realm of manifest changing.
Mm-hmm.
Um, it's so hard not to act. You feel like you need to do something, but
Right.
sometimes the best the best scenario is to let things unfold. Let market
Right.
forces interact and let market forces prevail.
Right. Like, have you ever seen that SpongeBob episode where they got the magic conch and they go, well, "Magic conch, what should we do now?" And they pull a string and it's like
Nothing.
nothing.
Yeah,
And then they all just sit there, and then the plane flies by and drops all the food for them.
yeah,
It's like, I mean, obviously, instead of a plane full of food, it's going to be a recession. But sometimes the best thing to do is actually just nothing.
right. It's really a topic that I can't stress enough how important it is. It really is just. It's not normal, you know what I mean? It's just something
Mm-hmm.
that seems normal because it's how it's always been for the last 100 years. Um,
Mm-hmm.
so it just seems like this is the people say don't fight the Fed. It's just like they just trust in the Fed, trust that they're making the right decision. But really, when it comes down to it, we got to speak out. We got to act. We got to
Mm-hmm.
we got to see the light as it's up to us as an informed citizenry that we, they're not just gonna they're not just gonna take their hands off it as much as we'd like them to. We gotta rise up and tell them, we don't want this interaction from you anymore. We don't want this intervention.
Right.
Well, that was a pretty good like hour and a half.
Mm-hmm.
I think that's a good place to end it.
Okay. Sounds good to me.